Hello, I'm Alex Burton, and this is the Business File. Inflation, recession, money supply, these are just some of the factors that make up the economic environment in which business has to function. And today we're going to examine that environment and its influence on business. An influence that's felt by every business, whether a corporate giant or the smallest mom-and-pop operation. Like other business environments, such as labor unions or the legal structure, or social responsibility, or government regulation, the economy is a factor outside management's control. What the business manager can do, however, is to understand and respond to the economy's shifting conditions. And that's what this program is about, the economy, how it influences business, and how business responds to those influences. Now, to help us understand this, we're going to talk with a businessman and two economists. And we'll be visiting first with Professor Lester Thoreau from his office at the Massachusetts Institute of Technology. In addition to his teaching duties, both at MIT and Harvard, Professor Thoreau has served as a member of the President's Council of Economic Advisors, a columnist for the New York Times, and a contributing editor for Newsweek magazine. Professor Thoreau, thank you for being with us. When I was doing research for this program, one of the first things I noticed was how business seems to go through periods of high and low activity, a sort of up and down movement. Now, to begin with, tell me, if this is right, and if it is, what is it called?
It's certainly been the history, and what we call it is the business cycle. And essentially, when we invented the Industrial Revolution, starting in about 1830 in Great Britain, industrial economies are subject to these cycles in the way in which agricultural economies are not, partly because it's so easy to cut back or expand production in an industrial economy versus an agricultural economy. And so in the 19th century, if you looked at both the United States and Europe, you would have seen these financial panics, depressions, recessions, all of these ups and downs. And of course, the greatest down in history was the Great Depression, where the GNP fell dramatically, 25% of the population became unemployed, and you had this tremendous collapse in the economy. On the other side, market economies are subject to inflation. The greatest inflationary pressures occurred in the 1920s when you had hyperinflation in Germany and China and various other places, Eastern Europe, where you would have inflation rates of 200% per day, things like that. And so market economies have been very unstable and very subject to the business cycle. And if it wasn't for that problem, the discipline of economics probably wouldn't exist.
Will you explain to me just how the cycle affects business?
Well, a whole set of things. If you think that next year your sales are going to go down and 30% of your production capacity is going to be idle, you're not going to invest this year. If you have a lot of debt and are worried that sales are going to go down and you're not going to be able to make your interest payments, then you may also cut back on research and development. And so they make life much more uncertain and much more worrying from the point of view of a businessman, because he can't have that kind of certainty that next year, if I do everything right, my sales will be better than this year. Because if you have the Great Depression, you can be managing your company perfectly and you will still go broke, because those external events are going to completely dominate what happens to you in terms of all the good things you do inside your company. And so businessmen get very nervous, obviously, when you're talking about business cycles in that kind of a context. And there is a demand to do something about them.
Earlier, when you described the business cycle's ups and downs, you mentioned inflation and recession. Let's focus on those terms for a moment. Now, to most people, inflation just means that money doesn't go as far as it used to. But how would you define it?
Well, if you think about inflation, the way we measure it is once every 10 years, the American government essentially constructs what's called a market basket of goods and services. They literally survey thousands of people and find what the average American buys down to great detail. And then once a month, literally, here again, thousands of people fan out from the Department of Labor, go to supermarkets, department stores, specialty stores, automobile stores, housing markets, and they price out that basket of goods and services. What would it cost you to buy that basket of goods and services? And it's basically the increase in the price of that basket of goods and services is what we refer to as the rate of inflation. And so if this year I could buy the basket of goods and services for $10,000, and next year it's $11,000, I would talk about a 10% rate of inflation.
All right. And what is recession?
Basically, if you're thinking about recession, the way we technically define that in the United States is any period of time when you have at least 6 months of negative GNP growth. And by that we mean that the total production of goods and services in the United States is going down. And so a recession is a period of time when the GNP is actually getting smaller. And of course, if the GNP is getting smaller, that means the sales of the average firm also have to get smaller.
All right, we know what inflation is, and we know what recession is. What I'd like to know now is how they affect business and the people who manage business.
Well, in both cases, you essentially create uncertainty. Because if you're talking about inflation, it means that you don't have the certainty of knowing what your materials are going to cost. The price of oil may be $1.80 today and $14 tomorrow, which of course is what happened between 1973 and 1974. And with that kind of uncertainty, you don't know whether, let's say, a chemical business that depends on oil as an input, whether that's a profitable business or not. Because it may be a profitable business when oil is $1.80 a barrel, and a completely unprofitable business if oil is $14 a barrel. And you create a lot of risk and uncertainty, and when businesses get risk and uncertainty, the kind of instinctive reaction is don't do anything. Don't make those investments. Don't put yourself out on a limb where you can be sawed off. Recession has much the same effect, because there your sales are going to go down, and you're going to be in trouble in terms of being able to sell your product. Let's say you're making tires, there's a recession and people don't buy cars, then you're not going to sell the tires, even if they're super tires, and you would make money if you were selling the tires. There just isn't any market out there for tires.
Professor Thoreau, we'll be coming back to you shortly, but I think now's a good time to present a segment we've prepared that illustrates the phenomena associated with the business cycle. The business cycle is a term used to describe fluctuations in economic activity, the alternating periods of expansion and contraction in the economic environment. Economists typically divide business cycles into 4 distinct phases. The peak phase, in which output is at its maximum in the economy. The contraction phase, in which output is declining, people are being laid off, and the economic outlook is pessimistic. The trough, in which economic activity has reached its low point, output is minimal, and businesses are failing. And finally, the expansion phase, where output is increasing, businesses are hiring employees, and are expanding operations. These 4 phases are often referred to as boom, recession, depression, and recovery. During the course of the business cycle, inflation may occur. It tends to occur late in the expansion phase, and as the cycle moves toward a peak, the rate of inflation will increase. With inflation, buying power has been increased faster than output. The result, money and credit have less purchasing power. In other words, too much money is chasing too few goods. Now that we have a grasp of the phenomena of the business cycle, we're going to see how it is understood by someone who looks at it not as an economic theory, but as a daily reality. Walter J. Heumann is the Chief Executive Officer of both Hunt Oil Company and the Hunt Investment Corporation. And as such, he holds the top management responsibility for these businesses' varied holdings, which include oil and gas operations, real estate development, agriculture, insurance, and ranching interests. And we're going now to Dallas, Texas to visit with Walt Heumann. Mr. Heumann, thank you for appearing on the Business File.
Alex, I'm glad you're here and looking forward to the discussion.
We've been examining the workings of the business cycle and how it affects business in a broad sense. But I'd like to know how the cycle affects an individual business like Hunt Oil.
A lot of ways. Hunt Oil Company is fairly diverse. We're involved in energy and agribusiness, insurance, and real estate. And as the business cycle goes up and down, it affects adversely or beneficially each of those various segments. For example, if we're in a time of high inflation, then costs really eat us up in the energy area. Cost of drill pipe and production and labor go up quite substantially. But conversely, when you're in high inflation time period, sometimes that oil price and the product prices track that commensurately. And so our profits don't get squeezed as much. In the agribusiness area, it's a little different. If the economy turns down and agricultural prices decline, generally the costs don't decline that much. And the poor farmer really gets squeezed from a profit standpoint. So it varies across the board.
These economic fluctuations obviously have a serious impact on your company. How do you respond to them?
3 ways, basically. You've got to plan ahead. There's not a perfect crystal ball, but you at least have got to do some pre-planning. Secondly, you've got to have a hedge plan. and that if costs start getting out of hand, you've got to be able to react quickly and cut some of those costs back, because our primary responsibility is to the customer and to our employees. And if we let our company get into a financial bind, then we do a disservice to all the employees. We cut back on costs. We try to expand our sales efforts. Sometimes that is through the means of additional marketing thrust, advertising, getting more salespeople on the beat, so to speak, in our insurance area.
Earlier, Professor Thoreau was speaking to us about the effect that inflation and recession have on business. In fact, he used the oil business as an example. Can you tell us how inflation and recession have affected Hunt Oil?
Sure can. Inflation, of course, is when those prices are rising, and in previous years they've risen very dramatically. What it does, it drives up our costs of labor. We were paying probably 50% more for a good exploration geologist and geophysicist. In terms of drilling pipe, a substantial increase. In some cases, we couldn't even get the drilling pipe that we needed for doing our exploration. So it just tightened the whole system up. Consequently, we had to pass on increased costs, and it's a vicious cycle that continues. The flip side is what we've seen in the last couple of years, where we've had a decline in some of those exploration expenditures, but a commensurate decline in the product price. Crude oil and our refined products have gone down. So in that whole process, we have to be nimble, we have to be flexible, we have to adjust with the times.
Mr. Heumann, I have more questions for you, but before we get to them, there are some other issues that need to be examined. We've seen how the economy's ups and downs can have a profound impact on businesses and their operation. Now let's see if there's any way to moderate or regulate the economy. We're going to the Hoover Institution at Stanford University in Palo Alto, California, where we'll be talking with Professor Milton Friedman. Professor Friedman is a teacher, an author, an advisor to 2 presidents, and the winner of the Nobel Prize for Excellence in Economics. Professor Friedman, it's a privilege to visit with you.
Well, I'm glad to have you here, and glad to welcome you to Hoover Institution, Alex.
We've been discussing the economic environment of business, the ups and downs of the business cycle, and I'd like to know if there's any way of providing stability to this environment. Do we have any mechanisms for controlling or at least moderating the cycle's ups and downs?
The 2 main devices that have tended to be used for stability are either monetary policy on the one hand or fiscal policy on the other.
Let's deal with these one at a time. What is monetary policy and how does it work?
Well, monetary policy deals with what happens to the quantity of money. Money, you carry pieces of paper around in your pockets, $1 bills, $5 bills, etc. If you're lucky, you do. And you also may have deposits at the bank. The sum of those 2 is what we call money. The total quantity of money in the country, under present circumstances, is really determined by the monetary authorities, in our case, primarily the Federal Reserve System. They decide how much money there shall be. And the instruments they have available with which to do that, the major instrument, overwhelmingly important instrument, is that they have a monopoly on printing pieces of paper or writing numbers on a book and using those printed pieces of paper or those numbers on a book to buy bonds, government securities. Or alternatively, they have bonds that they own that they can sell. These are called open market operations. When they go into the market to buy a bond, they just print the money to pay for it. I say print. In fact, most of it is an accountant's entry because you write a deposit on a book, but they essentially can create money or they can destroy money. In the process of doing that, however, they set and train forces which lead to an increase or a decrease, or a more rapid increase or more rapid decrease in the total quantity of money outstanding. So open market operations are the main instrument of monetary policy.
So monetary policy is intended to influence the money supply, and the prime tool is open market operations. Well, what other tools are there?
There are also 2 other instruments that are important. One is reserve requirements. A commercial bank, the bank you deal with, is required to have a certain level of deposits at the Federal Reserve Bank related to the total volume of its liabilities, of its deposits to the public. For every $100 of deposits the public has at the bank, it has to keep a certain fraction, depending on its exact size and so on, at the Federal Reserve System. That's called reserve requirements, and the Federal Reserve has the power to alter those reserve requirements within a certain range. And the third primary tool is something called the discount rate. And that's what happens there is that a bank, a commercial bank, would like to make a loan, but it doesn't have enough money. It can go to the Federal Reserve and borrow. In borrowing from the Federal Reserve, it pays a certain interest rate. That's the discount rate. And the Federal Reserve system can make that higher or lower. If they make it higher, they discourage banks from borrowing. If they make it lower, banks are encouraged to borrow, and that tends to influence the quantity of money. But of these three, the first, open market operations, are overwhelmingly the most important.
Now I understand the purpose and tools, but how does monetary policy affect the business climate?
Let's suppose the Federal Reserve expands the money supply more rapidly. Then somebody or other somewhere has more cash balances than they had before. Maybe they want to use the cash to go out and buy an automobile. Well, then that increases spending on automobiles. Maybe they want to use the cash to construct a new factory, then that increases spending on investment.
Well, how does that spending affect business directly?
After an interval, it will lead people to spend more. And as they spend more, that creates a demand for goods and services which business enterprises produce. That tends to produce an expansion. Conversely, if the Federal Reserve slows the money growth or reduces it, people have less cash on hands.
So monetary policy is one way of influencing the economy. Now tell me about the other. What is fiscal policy?
Fiscal policy really has to do with taxing and spending by the government. It really has to do with how much the government spends, what taxes it imposes, and how much it imposes in taxes.
In terms of economic theory, how is that supposed to affect business?
The belief has been that if the government spends more relative to its taxes, if it increases spending but doesn't increase taxes, for example, that will stimulate the economy. Similarly, the other way, when a boom is going on. The argument is that fiscal policy can counteract the boom, prevent it from getting out of hand, by raising taxes or lowering spending.
Professor Friedman, we'll be coming back to you in a moment, but right now, I want to return to Walt Human in Dallas to find out how someone in business experiences what we've been talking about. Mr. Human, Professor Friedman was just explaining how the Federal Reserve uses monetary policy to stimulate or slow the economy. And I wonder how much the individual business feels these high-level adjustments. For instance, how do the Federal Reserve's actions affect your own company?
Very directly. When the Fed tightens the money supply, it has a direct impact on a cost of capital. And in our particular case, and especially in the real estate field, it has a dramatic impact. If interest costs rise and too dramatically, it completely chokes off the entire environment. Real estate industry basically shuts down, and that has a ripple effect in the construction industry and the suppliers and what have you. The converse is true. When the interest rates decline, there's more optimism about the future, and the pump starts getting primed again. I'd like to point out, though, that there's the reality and the perception. Sometimes the perception is just as important in terms of dictating what happens in business as the reality. So that if I think interest rates are going to go up, even though they're not, and may not for the next couple of months, but if I think it, then I will act accordingly.
But whether the effect is real or psychological, you do feel it. Well, what about government fiscal policy? Do you feel that too?
Yes, we do. For example, the government activity could be in the form of increased taxes or tax policy. And I'll give you a specific example. We were fortunate enough to participate in a North Sea exploration find there. We were fairly aggressive in our exploration activities. The British government dramatically increased the tax rate, and within a 2-month period, we shut down all further exploration activities. It's very, very sensitive. It goes back to the perception, but also the reality. If we perceive that the British government or the U.S. government is going to increase or decrease taxes, we act accordingly.
We've been discussing monetary and fiscal policy as though they were completely separate experiences, but in fact, they both work on you at the same time. And the two in combination must affect you very strongly.
Yes, most definitely. When those two things play on our business operations, sometimes it's very difficult to sort out which way our company will be affected. For example, in a time of high interest rates and declining inflation, what are those signals? Should we go forward full speed ahead? Should we be a little more cautious? Should we retrench because of the increased cost of capital, but the reduced cost of labor and some of our goods and materials?
Well, before we pursue some more questions along those lines, I'd like for us to pause a moment. We've prepared a graphic to illustrate the effect of monetary and fiscal policy on the business cycle. The business cycle is a phenomenon. It does not have a perfectly symmetrical series of peaks and troughs or phases of expansion and contraction. On the contrary, the expansion phase may push onward to a peak period, and the trough period may plummet severely. Monetary and fiscal policies have been tools utilized to try to influence the business cycle and to moderate its extremes. In the contraction phase, economic outlook is pessimistic and output is slowing down. In an attempt to prevent a severe recession from occurring, the federal government has utilized fiscal policy, either increasing government spending or lowering taxes to stimulate the economy, or the Federal Reserve System has applied monetary policy to open the valve in the money supply through buying Treasury securities in open market operations, lowering the reserve requirements, and reducing the discount rate. To limit the possibility of inflation in the expansion phase, fiscal policy has been applied, either decreasing government spending or increasing taxes. Or monetary policy has been used to tighten the valve on the money supply by selling Treasury securities or raising both the discount rate and reserve requirements. Both monetary and fiscal policy are used with the understanding, one, that government can only influence the money supply and buying power, but does not have direct control, and two, that there is a lag time between the policy and the results. Now that we've seen the effects of monetary and fiscal policy, there's a final question which I want to ask each of you in turn. From our discussions, it's obvious that business is strongly affected, not only by the economy, but also by the government's economic policies, everything that we've been calling the economic environment. And it's also obvious that to succeed, and sometimes just to survive, whoever is involved in business has to cope with this environment. What I'd like to know is how. Professor Friedman, what strategies would you tell a business manager to adopt to operate successfully in our economic environment?
I would say you know more about that than I do. That's your business. That's not mine. I'm an economist. I'm not a businessman, and I'm not a business advisor. The businessman is much shrewder about his own business than I can be. I would only tell him that he should be aware and try to keep informed of what are the general tides in the economy, whether the economy is expanding or contracting.
Professor Thoreau, do you have any strategies to offer for successfully operating in the economic environment?
Well, one of the strategies which works in the short run but hurts in the long run is you essentially have a very short time horizon strategy. You simply say, let's focus in on the next year or two when I can be reasonably comfortable that we're not going to have any recessions or a big outbreak of inflation, and what can I do profitably over that short run period of time? Of course, if that's your strategy all the time, then you get into the problem that you don't do some of the long run things that you really have to do, like research and development, to have a successful company. Another strategy is to try and kind of diversify yourself, where you're in more than one business at the same time. And a lot of the conglomerates were put together because the argument was that the business cycle is going to be slightly different in different industries. And so if you're partly in automobiles and partly in computers and partly in financial services and partly in insurance, these things won't all go up and down at the same time. And so you'll even out the ups and downs because different parts of the business will expand and contract in different periods of time.
Mr. Heumann, speaking as the shrewd businessman that Professor Friedman mentioned, what strategies can a business adopt to successfully function in this economic environment?
A number of strategies. First, you've got to plan ahead. Probably 50% of all top management time in business has got to be spent on planning, strategizing, and playing what if. What if the economy increases? What if it deflates? What if the interest rates are high or low? And with the new technology today, with computers and PCs, that you can play what-if games and in a matter of a few minutes have the impact of that rather than waiting weeks for a fine and fancy report to finally come back to you. So you've got to plan ahead. Secondly, you've got to be flexible. You've got to have a hedge plan. Never put all of your resources so that if things go wrong or go against you, that you've lost it all. You've got to hedge a bit. Third, you've got to basically have a degree of optimism. That if I wanted to, I could hang the black crate so much that I would never do anything or want to expand, because there is always that additional business cycle which may carry interest rates higher and inflation higher and customer demand choked off. But if I worried inordinately about the negatives, we'd never have any positive movement in the business.
Mr. Heumann, thank you very much for your insights and observations. You've been more than helpful.
Alex, it's been my pleasure, and come back again. Look forward to seeing you.
And, of course, special thanks to our other distinguished guests, Professor Thoreau and Professor Friedman.
Well, thank you.
The business cycle. Its periods of inflation and recession have a powerful impact on business and business planning. For the person who runs a business, it means risk and uncertainty. But as difficult as it often is for a manager to deal with the uncertainties of the economy, it's a necessity. It's a certain disaster if the economic environment is ignored. The survival of a business depends on trying to understand, to plan for, and respond to its presence. Until next time, I'm Alex Burton, and this has been The Business File.
The preceding program is part of a college credit course.